Bitcoin enters this week carrying both a long memory and fresh bruises. The rally after the 2024 halving felt relentless for many months. Then a sharp December shakeout reminded traders that leverage never disappears, it only relocates. Now, the Federal Reserve stands near its first easing step of this cycle. Historically, halving years tend to intersect with changing macro liquidity regimes. Sometimes Bitcoin rises alongside an easing Fed. Sometimes it peaks before policy actually shifts. What matters most is not the slogan of easy or tight money. What matters is how expectations about future liquidity are evolving beneath the headlines. This week, those expectations sit at a delicate intersection between hope and fatigue. Some investors see the first cut as green light for another speculative surge. Others view it as confirmation that the cycle is aging and risks are building. Our goal is to step back from the noise and study the structure. We will not guess prices. We will examine behavior across previous cycles and today. Bitcoin's design encodes mechanical scarcity through halving, but human behavior around it stays messy. Each reduction in new supply compresses narratives, fears, and ambitions into a tight window. Looking across previous cycles, we see that price paths differ, yet patterns rhyme. Momentum often accelerates after halving. Then volatility rises as late leverage crowds in. In earlier eras, the market was dominated by retail traders and lightly regulated venues. Information moved slowly, liquidity was patchy, and derivatives infrastructure was still primitive. Those conditions magnified boom-bust dynamics around each halving narrative. Sharp expansions in open interest were followed by equally sharp unwinds when sentiment flipped. The current cycle adds new structural players who change but do not erase history. Institutional vehicles and spot exchange-traded funds channel long-horizon capital into Bitcoin. Custodial solutions are stronger, reporting is tighter, and governance frameworks are more mature. Yet alongside these flows, leveraged traders still ride funding rates and perpetual swaps. Post-halving periods often become tug-of-war between genuine adoption and speculative leverage. When macro liquidity feels supportive, leverage can masquerade as adoption for a while. When conditions tighten or simply stop improving, fragilities built during the run become visible. The early December shakeout fits that familiar script of stress testing late entrants. Compared with earlier cycles, however, responses from long-term holders look more measured. On-chain data suggests many older coins remain dormant despite recent swings. This does not guarantee smooth paths ahead, but it indicates deeper conviction capital. Conviction capital can absorb volatility, yet it does not fully neutralize leverage cycles. Halving therefore acts less like a magic trigger and more like a pressure point. It compresses attention and supply, drawing in narratives that amplify each move. But the magnitude and duration of rallies depend on who holds coins afterward. Is the marginal buyer a patient allocator or a highly leveraged speculator? In this cycle, both groups are present and entangled in complex ways. Understanding their interaction after the halving is key to reading current volatility. History shows that when leverage dominates, drawdowns deepen and recoveries become more fragile. When patient capital slowly accumulates, corrections still occur, but structural floors evolve over time. To see who really drives this market now, we must separate flow types. On one side stand spot vehicles and institutional mandates with explicit time horizons. On the other side, stand traders operating with borrowed money and short feedback loops. Both groups buy Bitcoin, but their reasons and constraints differ sharply. Institutional capital usually moves along approval cycles, risk budgets, and rebalancing schedules. Its activity often clusters around quarter ends, index changes, and major policy signals. Once allocated, these positions tend to endure volatility better than leveraged derivatives accounts. Loss tolerance is not unlimited, yet it is framed over longer horizons. Leverage behaves differently because it is bound by margin calls and funding rates. A trader can believe in Bitcoin's long-term story and still be forced out. When volatility spikes or liquidity thins, collateral values drop faster than conviction can adapt. That dynamic explains why liquidation cascades appear even in broadly bullish narratives. Early December offered another reminder of this tension between steady and fragile money. Spot holdings inside institutional vehicles barely moved, while derivatives positioning saw aggressive unwinds. On-chain, we can observe coins leaving some exchanges yet remaining within custodial structures. That pattern looks like leverage cleanup more than long-term exit from the asset. For long-horizon observers, this distinction matters far more than a single weekly candle. If structural demand remains intact, volatility shakes out weak balance sheets, not core belief. If structural demand dries up, even modest leverage can turn corrections into deeper trends. So flow analysis is less about predicting the next tick and more about resilience. Today, the presence of exchange-traded funds has two subtle effects on market dynamics. First, they channel some demand into vehicles that do not face liquidation cascades. Second, they create a visible benchmark for traditional allocators watching crypto from the sidelines. Both effects support the idea of deeper but slower moving capital inside the system. However, this does not mean institutional flows always stabilize prices or mute drawdowns. Large holders can rebalance, redeem, or hedge when volatility breaches their internal thresholds. Their actions might be slower than retail exits, yet still significant when synchronized. Understanding both sides of this equation helps us interpret what recent moves truly signal. We now return to the macro backdrop because it shapes both groups simultaneously. For Bitcoin, the crucial variable is not just the level of rates today. The crucial variable is how expectations about future liquidity and real yields are shifting. When investors believe liquidity will expand, they tolerate more volatility in risk assets. Conversely, when they expect conditions to tighten or remain restrictive, they demand greater compensation. You see this in credit spreads, equity valuations, and in how traders price volatility. Crypto sits on the edge of that spectrum, most sensitive to shifts in marginal liquidity. Even small changes in funding conditions can amplify swings when leverage has grown quietly. The upcoming easing step therefore creates an interesting paradox for Bitcoin observers. A cut can signal relief from past tightening or concern about future growth weakness. In one narrative, liquidity returns, and high beta assets breathe easier for a while. In another narrative, the cut marks recognition that the cycle is late and fragile. Real yields tie these stories together because they capture return after accounting for inflation. When real yields fall due to lower expected tightening and anchored inflation, risk assets benefit. When real yields rise because inflation fear fades slower than policy easing, risk assets struggle. Bitcoin has responded to both regimes at different times, sometimes more like tech equity. This complexity is why simple slogans about money printing often mislead new entrants. Liquidity is not a single on-off switch controlled by one meeting or headline. It flows through banks, bond markets, shadow lenders, and risk mandates across the world. Bitcoin reacts to the combined outcome of these channels, not to slogans alone. For the current environment, the key is humility about what we truly know. We know that policy is shifting direction after a long plateau of tight settings. We know that leverage has recently been flushed from parts of the crypto system. We do not know how growth and inflation will evolve over the full next year. That uncertainty is why frameworks matter more than bold predictions during transition phases. So how should a long-term observer digest this confluence of halving, leverage, and policy? First, by accepting that volatility is a feature of this asset, not a temporary bug. Second, by distinguishing between structural holders and transient leverage positions when reading market moves. Third, by watching liquidity expectations rather than obsessing over one policy decision or headline. History suggests that Bitcoin can live through many policy cycles and still preserve its narrative. At times it behaves like a high beta expression of global liquidity sentiment. At other times, it decouples for stretches, driven by internal adoption or industry-specific shocks. Recognizing these shifts helps you avoid forcing one explanatory story onto every move. The coming months will likely deliver more headlines about central banks, regulation, and technology advances. Some will sound euphoric, others will sound alarming. Most will fade quickly from memory. Your advantage can be staying anchored in a clear framework, while others chase each wave. Bitcoin, after the 2024 halving, now sits between cleansing leverage and testing new demand. How it travels from here will depend less on declarations and more on liquidity over time. In that uncertainty, a calm, disciplined mindset is still the most durable edge available.